This A+ SMC trading strategy is so simple and boring to trade, but it makes me money consistently. And in this video, I'm going to share with you every single part of that strategy, a step-by-step breakdown of each rule, and a trade example executing this exact strategy. So stay tuned. It's going to be a great video. So the trade that I'm going to be breaking down and the trade that was taken using this exact strategy is this London session sell trend continuation model. The first thing that I like to do is get the direction. What does direction mean? I like to use the 15-minute swing structure, and that will give me my direction for the day. For example, if I see the 15-minute time frame putting in these levels, you can see that each high is getting progressively lower and each low is getting progressively lower. We're making a series of highs, higher low, higher high, higher low, higher high, higher low. All you're expecting from here is eventually a new higher high. And if we break in here, you're eventually expecting a pullback and continuation. And my job as a trader, this entire model is built off of, is after a break of structure, wait for a pullback, wait for certain things to happen in here. And I want to basically try and sell at the top of this leg and take out the lows. I want to be selling in this area and trying to target this level. Again, selling in this area, targeting this level. And again, as price comes back up, I'm looking to sell in these areas and simply just target the lows. So the 15-minute swing structure and my directional bias for the day is decided based off of market structure. And market structure is really simple. At any time you're printing higher highs, higher lows, or you can shift from being bullish to bearish. So this is a change of character. And this is a series of lower lows, lower highs, lower lows. And you just trade in the direction of that trend. Here we have a break of structure, a break of structure, a change of character. This is a swing low that puts in a higher high, and then that high puts in a lower low. So this becomes a change of character. When we get a change of character, then we shift. Now we're trying to short the market. And then we get a break of structure, we're trying to short the market, break of structure, and then we want to short from somewhere in here. As price comes back, we want to short this move. That is literally it. Now, the problem is the swing structure isn't always that simple, right? If it was that simple, everyone would do it. A lot of the times you're taught structure like this, which is really easy, but then you come to analyze price in real time, and all of a sudden it's like this. You look at price, you look at the market, and this is what the structure looks like. And you have to still try to decide what your swing structure is. And this is the thing that I see so many traders get wrong. If you don't have a repeatable way on what makes a lower low and what makes a higher high, and how do we know if it's a break of structure or whether it's internal? How do we know whether it's a change of character or it's just an internal liquidation? If you don't have rules for these things and you just have an idea that I should be trading with the trend, I should be using market structure, if you don't have rules and then you don't prove those rules with data, I promise you, you won't be profitable. You have to build these rules. Either build them for yourself or take them from someone, but make sure that they're actually accurate. What I've done at this point in my trading is I've taken my rules now that I know they work and they've been working. I'll just show you the data. This is the strategy that I'm teaching you right now. You can see this is over 2.5 years of data, hundreds of trades, over 200 trades executed. These are the numbers. Every trade that I lose 1. Every trade that I win 6. On average, I win 40% of my days. On average, I win 33% of my trades. This looks small, but I win 3 or 4 in 10 trades. But when I win 6. So just do this simple math. Let's say we take 10 trades. Say 7 of them, are losers and 3 of them are winners. When I lose 7. But when I win, I gain 6.14. So I actually end up gaining 18.4. Now, minus the difference, over 10 trades, I'm up 11.4. Even though I lose most of my trades, right? That's just the simple math of my model. Everyone wants a 75% win rate strategy, and then they also want a 1 to 5 risk to reward. You're not going to get it. You can have a 75% win rate strategy, but you might be going for a 1 to 1 risk to reward. You maybe might get a 1 to 2 risk to reward at a 75% win rate, if you're very fortunate to have a system like that. But unless someone's going to show you the data, don't listen to what you hear on YouTube. Everyone will tell you 80% win rate, 70% win rate, 90% win rate. But unless they show you the stats and the receipts to back it up, I just don't listen to them. Because in my models, I have over 1,154 executions. These aren't baby numbers. That's 1,154 trades. And that's the data on them 1,154 trades. 2022, 2023, 2024, and 2025. That's over 3 years of data, over 1,150 executions. So yeah, anyway, is this a change of character? Or is this the swing low? These are the types of decisions that you're going to have to make in real time. And I can tell you, use the swing structure. But you'll still come and say, well, is that a swing or is that the swing? Okay, I know that's the swing because it's the furthest point that price pulls back before we break structure. Then we break structure. So I know that's a high. Okay, we respect this. So I know that's a low. Okay, that's a high. But then is that a pullback? Is that a change of character? Or should I be expecting higher prices? This is where it gets really kind of tricky, really confusing. So if we apply that logic now to live market, this is what price looks like. So this right now is the range that we're in. This is where we're shorting from. Unless you have specific rules that you can follow, how else would you define this? Maybe you look at it like this. Oh, okay, that's the structure. So now we're bullish. So what, from the 6th of May to the 14th of May, you're going to just try and buy the market every single day? It wouldn't work out too well. And this is what you're going to target. And so technically right now we should still be buying. How do you define it? You'd look at it and you're like, okay, well, this is it. Because you can see it works quite well for some period. But then you'd still be long in here and you'd be spending a long time trying to long here. And then you can look at it on the flip side. Again, let's imagine we're not in here. Is it like this? And then, yeah, you have to build your rules. What makes, is this a high? Is this a high? Is this a low? Is this a low? Is this a high? You have to decide this. And you have to decide it in a repeatable way, meaning a set of rules that tell you this is the high, this is the low, this is a break of structure, this is the change of character. And then you have to prove them. I had to do it myself. I went out, I tested many different rules, this type of pullback, this distance in pip range, X, Y, Z. Eventually I settled on the thing that worked the best for me. And this data that you're looking at here, this is built off of that rule. So in these executions on that specific strategy that I'm teaching you today, I follow the same market structure rule every single time. It does not change. And to make my life easier, I coded it into my own algorithm that gives me my own indicator. Because at this point, I don't need to guess. I already know my rules. Instead of me having to just look at it myself, I think it's just easier if it's automated. I hired a team that built the algorithm, that ran the logic, and now I have this, which is my indicator. So now I have this little icon here, and this tells me my market structure. So I know that if we look before we take this trade, because we don't even know why we're taking the trade yet, I already see that the 15-minute time frame is bearish. The 1 minute is bullish, the 4 hour is bearish. So I already know that I'm expecting the 15-minute to be bearish. It even shows me. Now I can go back in here and I can find all the swing points. I can find, okay, this was a swing high, this was a swing low, this was a break of structure. Now we shifted bearish in here. We shifted bearish, we respected the high. We went and put in a new lower low. Okay, so I know right now then that this is the swing high and this is a swing low. So I know that number one, what I know because of this is I want to look for shorts. Number one is I want to sell. Number two is I know that I'm going to sell somewhere between this high and this low. So I'm going to sell somewhere inside of here. That's it. And I know that I'm going to target this low down here and probably this previous week's low, this low in here. I know that I'm going to target here and here, and I'm going to sell somewhere in here. That's just what market structure alone does for me. This is why there's many different rules. Market structure alone won't solve everything for you. But to bring it back full circle, I use swing structure to identify my trend, and I only trade in the direction of the trend for this specific strategy. And you need specific rules. I can teach you this, use swing points, but when the price ends up looking like this and you don't know which swing points to use, or today you use, if we look at this example here, today, maybe that's a break of structure, that's a change of character, now you're trying to long in here, and then next week, that's not a break of structure, that's not a change of character, and you're still trying to sell here. I know this because I've been there, which is what led me to build my rules in the first place, because I kept on finding that my structure was just random. Anyway, long story short, so one of the features of my SMC engine is swing structure. It also does more as well, but I'd probably say one of the most important ones is the structure. Again, if you want an indicator that just automates that for you, you can check it in the description. I'll leave a link there. The first things first is trading in direction of the trend. The second thing is going to be location, because it's not good enough to just know what direction you want to trade. We need some kind of contextual trigger. And again, these rules that I'm giving you, these are the actual rules that the strategy is made of. So let's say now we're bearish. Now, what does that mean? Do I sell here? Here? Like when in this price leg do I sell? That's the next question. Because like I showed you already, technically I can short from anywhere in here. And what I noticed a lot of people do, and something that I fell victim to at some point as well, is this concept of premium and discount, right? You've probably heard it before. Use the Fibonacci retracement level and you'll use the premium and discount. We'll take the fib in here. And essentially, you know, you have these levels, 50%, 618, 786. And then you define your trend. You're like, oh, this is the perfect level to retrace. And if it's above 50%, it's in premium. I want to sell in premium. And if it's below 50%, it's discount. I don't want to sell at a discount. That's the logic that I used to think was accurate. And the reality is it's just not accurate. Now, what I noticed is when I ran my tests and built my data using premium and discount, I was still profitable. But I took so many less trades and I avoided so many trades that were great trades, but because they were in a discount, it wasn't. And who decides what a discount is? A Fibonacci retracement does not decide what a discount is. All a Fibonacci retracement is a data collection that shows you the average pullback inside of a price range. So you can go and test, you know, 1,000 swing structure points and on a graph plot what pullback level they did. So did they pull back, you know, 1% of the leg and go lower, 2% and lower, 3% and lower, 4% and lower, and so on and so forth, all the way up to 100%. And what literally all you will see is some type of bell curve like this. All you'll end up seeing is this. And there's this kind of area here between like 50 and 60% that people think is the golden area. But in reality, that's because they look at this and they think they see this, but that doesn't mean that you should just trade that, because there's so many times where price might pull back 4% into the range and continue, 10%, 15%, 20%, you know, 30%, and then continue in that trend. And there are some times where price will pull back 70%, 80%, 90%, 99%. But how many pull back 99% versus how many pull back 50%, you'll just see this bell curve. You'll just see a huge differentiation between them. But I'm telling you, it doesn't do anything for you. And I tried all these things. And one of the biggest things that I found is it's session dependent. So if I'm in the London session, what I found is that in the London session, the session before is a good indication. So I found that if I'm in the London session and the Asian session leaves highs, after the Asian session is taken, then I look for shorts. If I'm in the New York session, then I wait for London high to be taken, and then I look for shorts. And I found that out of everything that I tried for understanding when should I short in here, that was the best one. And so that's what I did. And so the second rule is for the London setup, which is this one. And by the way, this strategy that I'm sharing with you right now, which is the intraday bias one, I have multiple different variations of this one strategy. So inside of this strategy, there are a few different setups. You can see here, these are the different types of setups. You can see this one, London, Frank, London, London, Frank, New York, LOL, LOL C, LOL R. That they have different meanings. All kind of along the same lines, but they are generally different rules. So the setup that I'm showing you today is the London Sweep Asia Trend Continuation model. There's another 5 or 6 variations, all very similar. And again, if you're interested not only in just the indicator that kind of maps your structure for you and your sessions and your order blocks and some other stuff that we'll look at later in the video, but you also want the access to my entire playbook. And you want to see, I have videos where every single one of these trades that you see here, every single one of these 230 executions trading this exact system, every single one of them, there's a video for every single trade. So that's 230 trades executed on video, trading one of the setup variations, and plus you'll get all of the rest of the setups and the indicator. And again, I'll link that in the description. It's all inside of one link. So yeah, so this is the London setup. So step 1, you have directional bias, which we know is bearish, right? It shows us here that it's bearish. We know it's bearish. Step 2 is location. So we're waiting for Asia session high to be taken. Asia session high is a setting that, again, I have in my SMC engine. Show Asia, show London, show New York. If you don't have this, your chart just looks like this, which is why when I make these videos, you might be like, oh, like, okay, cool. It looks great, but our charts look different. I'm always getting comments in the YouTube video like, what's the indicator that you use? How do I get the sessions? Well, this is it. Asia session in blue, New York in orange, and green is London. So now we're going to wait for the Asia session to get swept. So we'll play price. London session opens, as you can see here. And then we sweep Asia, right? Meaning we get above Asia. So now we move on to step number 3. Step number 3 is, again, part of location. So we have direction, we have half of location, but we need another part. And that part is confirmation. So you can have direction. So we know now then that the direction is based off of the trend, and the trend is bearish. So we have our swing high, breaker structure, our swing low. We know that we're bearish. We use the 15-minute time frame, and then we pull back in here, and now we have our Asia session is here. But that's our location. But what then? Like, do we just sell as soon as we break above Asia? No, because there are so many scenarios where we break above Asia, we continue all the way to the edge of the price, only then we get our confirmation, and then we get our trade. How many times would you have sold in here? So there's another part of this, and that is after you get the sweep of Asia, now we go to the 1 minute time frame, and we wait for the 1 minute time frame. You see right now the 1 minute time frame is bullish. We just simply wait for the 1 minute to go from bullish to bearish, for it to align itself with the overall trend. Because essentially, when price puts in a lower low, and then it starts to come back, on the 1 minute time frame, you're going to be bullish. And when it goes and puts in the low again, at some point very early on in here, the 1 minute shifts back to bearish. And then the trend continues. And then we take out these lows in here. So this is our edge right here by finding this discrepancy. And how does that look? Let's take a look at it. So now we're above Asia, we're going to drop to the 1 minute time frame. And again, we have our SMC engine. Though honestly, if you want me to be honest with you, the 1 minute time frame is the most confusing. The 15 minute without the SMC engine is bearable. It's annoying, but it's bearable. Bro, the 1 minute time frame without the SMC engine, I kid you not, you could easily spend 20 minutes, 30 minutes in this type of market environment trying to map the M1. Because look at it. Look at how rangy it is. And you have to, first of all, you have to have a rule, which I already have. But even when I have a rule, I now need to go and look at all of this price action manually to see, okay, does it meet my rule? Does it not? Okay, is it high? Is it low? And this specific type of M1 price action where it's just so choppy and the M1 range is also large, it's horrible. So right now we are bullish. As you can see by this, we can see here, M1 bullish. We have a swing low here. We have a breaker structure here. So we're bullish right now. This is the M1 swing low. So keep playing price. So we're bullish. Right now, we'd probably be expecting price to continue trading bullish. And all we're doing is waiting for it to go bearish. And so either one of two things is going to happen. Either we were going to break out here and then do this, or we're going to break this low. Now you can see the 1 minute has shifted bearish. We've got a change of character down here. This is the new swing high. We have a change of character. So now we've confirmed bearish. So now we can see that the 15 minute and the 1 minute are both in the same direction. They're both bearish. Now we have real confirmation that now we can get ready to short, which leads you into your next problem, right? So once you've got your direction, then you need your location, and then you need confirmation of that location. And after you've got the confirmation, you need your POI or your point of interest. Because again, you don't want to sell limit on the change of character and put your stops above here and you're down here. Even if you go to previous week's low, which is a good target for this trade, it's a 1 to 2 risk reward. Now you might be thinking, that's not terrible, 1 to 2 risk reward. And it's not terrible, but it could be so much better. And so what we're going to do is we're going to come in here and we're going to enable order blocks and fair value gaps. And then what I always do is I go to the 5 minute time frame, and my 5 minute time frame, I look for my area of interest, my point of interest. And that is always an order block or a fair value gap. If you're not a complete beginner, you probably already know what an order block and a fair value gap is. If you are kind of really new to smart money concepts or just in general, a fair value gap is a formation where you have 3 candles, and then you have this gap between candle 1 and candle 3. So you see here how candle 1 and candle 3 don't touch each other. That right there would be a fair value gap. Efficient candles generally will look something like this, for example, where there's no gap between 1 and 3. Or it could even look like another bearish candle, but the wicks are pretty high, meaning we actually had a good amount of opportunity in here. So that's not a fair value gap. An order block is essentially a range in price. So a range in price before an aggressive expansion, or we call it supply and demand. A demand zone is a range before an aggressive bullish expansion. A supply zone or a bearish order block, a range before an aggressive expansion. So you can see here, right? This right here is a range before an aggressive expansion that also has a fair value gap. So here we have an order block and a fair value gap. And notice that price touches both of them. So now they've been traded, they're no longer really of interest. So the next one would be this range and this fair value gap. So we can literally just go ahead and that's going to be our area of interest. And our stop loss is going to go above the highs. And our take profit is going to go the swing low, the direction of price, previous day's low. And then I would also anticipate that previous week's low would go. A good liquidity target is also for this trade, previous week's low. So we have take profit number 1, previous day's low, and take profit number 2, previous week's low. Previous week's low and previous day's low, and this part of the indicator, the directional bias, I'm not covering in this video, but again, it's part of the indicator training if you do end up wanting the indicator to make your trading better. And then you just wait. So direction, location, confirmation, point of interest, and then your targets, and you just wait. Price comes back in, tags us in. We sit in this area for a while. Again, we just sit in this area for a while. It happens as well. New York session comes, we do get a bit of volatility toward our direction. And there's our first target hit. So now we've hit our first target. And then the second target also gets hit. And yes, this is a trade that follows the exact rules of this trading strategy. This is not cherry pick scenario. This is an actual execution. This is an actual trading strategy. And again, if you want the indicator and the trading strategies and all the training, the link is of course in the description. Hope you enjoyed and subscribe if you want more videos.